What's going on, my fellow stock market trader and investor homies? It's your boy Kevin. Welcome back to the channel. The stock market has been extremely bipolar over the last 2 or 3 months, not knowing what it wants to do. Does it want to retest those all-time highs, or are we finally going to see the crash or correction that everybody and their mother has been predicting? Well, Larry McDonald, who is well respected in the market, sells the bear trap report to a bunch of hedge funds and trading desks. It is a risk analysis assessment, and he's very well respected in this game. Well, Larry McDonald is now predicting that the crash is here. Jerome Powell and the Federal Reserve have had the stock market by the balls over the last several months. Market, investors, everybody's watching his every move. If he has a speech and he sounds like he's about to take his foot off the brake and maybe put that foot on the gas and start slashing and cutting rates, the market pops. However, if there's a speech or he's testifying in front of Congress like this week and he's talking about having to raise rates higher than initially expected, the market absolutely collapses. And that's what we saw this week. And this dude, Larry McDonald, he is saying that we are going to see the crash. His word, not mine. I know some people get butthurt when the word crash is thrown around, but this dude, this expert in this space, is saying that he is expecting a more than 30% decline off of today's prices in the overall market. We know that's a huge move when you're talking about not just the specific stocks. Like we could see a 30% move in Tesla to either direction, while the overall market's only up 3 or 4%, right? These high beta stocks like Tesla, Nvidia, Apple, these big blue chip high beta stocks, if the stock market drops 30%, what are these stocks going to do? You could see a 50, 60, 70% decline in these names. So this is really big. This is really important. And we're going to be breaking it down. I'll show the clip. We'll talk about it. I'll also show some of the clip from Jerome Powell testifying in front of Congress, because I think it's really scary. His speech in front of Congress really had my butthole puckered up. So let's break it down and let's get it. All right. So this is this dude. He owns this company, the Bear Trap Report. He sells this advisory letter to family offices, hedge funds, portfolio managers, trade desk, and retail investors. So let's see what he had to say.
Well, it's kind of like he's overcooking the goose. They're playing catch up, and while they were doing quantitative easing in 2021, inflation started to rage, and now they're trying to catch up. Our 21 Lehman systemic risk indicators that look at equity and credit point to one of the highest probabilities of a crash in the stock market.
Highest probabilities of a crash.
60 days.
Within 60 days.
60 days? You're saying you're going to see it? We're going to see a crash in the stock market within 60 days?
Yes, because the withdrawal of capital from the middle-class families is...
All right, so that's enough of that. I'll talk about a little bit more about what he says in his theory here. All right, so he's saying that within 60 days, we're going to see a substantial stock market crash. And his reasoning is very, very valid, okay? All right, so what is he talking about? Right now, if you look at the overall market, let's go to the S&P 500. This is a 2-week chart. Let's go to a monthly chart, all right? So if you had invested money in the stock market in February of 2021, right now we're in March of 2023. So 2 years ago, so let's say you put your big time family office, your family hedge fund, and you got $10 million under your control. You put it in the stock market, you just buy the indexes, you're looking for 7, 8, 10% a year in returns. What are you sitting on right now? You're sitting on a 0% return over the last 2 years. Why is that important? Why is that important? Well, that's important because you can go out and buy, let's see, 2-year Treasury yield. The 2-year Treasury yield is down a little bit today, but it hit as high as 5% just as soon as yesterday. So, a couple years ago, these Treasury yields we're like in the 1%, right? Maybe even less than that, right? They hit a low as 0.12%. So you really didn't have many options. If you wanted that 7 to 10% return, you had to put it in the stock market. You could go buy indexes if you wanted. If you weren't very risk adverse, you just go buy the SPY, the triple Qs, and some of the big indexes or the ETFs, and you were hoping to make 7%, these big hedge funds, right? No longer is that required. Now, instead of putting your money in a market that hasn't given you a single percent return over the last 24 months, you can now take the money out of the market and put it into a 2-year treasury bond or a 10-year, even a 10-year, right? So it makes sense for these big money players in the market to start withdrawing money out of stocks and putting them into these treasuries. And that is scary, folks, because guys like me and you, we don't really affect the market with our $50,000 account, our $100,000 account, even $1 million account. But if thousands of dudes with $50 million accounts start taking all their money out and putting that in treasury bonds, it's a problem. It is a big problem. All right, so let's see what Jerome Powell had to say when he was in front of Congress. I believe he was in front of the Senate. Yeah, he was in front of the Senate. And what he had to say is not sounding like we're at the end of the road here. We're not anywhere close to the Fed taking the foot off the brake. Sounds like they're about to pull the emergency brake, to be honest.
Semi-annual monetary policy report. My colleagues and I are acutely aware that high inflation is causing significant hardship.
Yeah, no shit.
And we're strongly committed to returning inflation to our 2% goal.
Yeah, you sure are committed, bruh.
Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We have covered a lot of ground, and the full effects of our tightening so far are yet to be felt.
Yet to be felt.
Even so, we have more work to do.
More work to be
Our
done.
policy actions are guided by our dual mandate to promote maximum employment and stable prices.
All right, this is the part that gets a little bit scary.
The flattening out in rents evident in recently signed leases points to a deceleration in this component of inflation.
That said,
there is little sign of disinflation thus far in the category of core services excluding housing, a category that accounts for more than half of core consumer expenditures. To restore price stability, we'll need to see lower inflation in this sector, and there will very likely be some.
So I'm going to pause it there. He goes on to say that he's anticipating having to boost rates higher than initially expected. This is not a good sign for the market. If they continue to raise rates, initially the CME FedWatch put a 80% chance on a 50 basis point hike, which can be expected March 22nd. The Fed is 100% going to raise rates on March 22nd, so we need to watch this. Are they going to raise it 25 basis points, or are they going to raise it 50 basis points? That is huge. If they raise it 50 basis points, that gives even more cause for concern. Why? Because not only does that affect the overall economy, make mortgages more expensive, not only does it make product on the shelves more expensive because it costs these companies more money to borrow money, but it also gives big-time investors and hedge funds more of a reason to take their money out of the stock market and put it into those treasury bonds. Because every time the Federal Reserve raises interest rates, the baseline interest rate, those treasury bonds yield increases. So right now it's at about 5% for a 2-year. If they raise it, it's going to continue to climb. If we see that number for the 2-year bond inch over 6%, why the hell keep your money in the stock market if the average yield is 7 to 10%? It just doesn't make sense for a very conservative big investor, right? It doesn't make sense unless you see that big crash. Once you see that big crash, the market comes off these current levels by, let's say, 30%, and it does one of these and corrects down to, say, 280, then there's a reason for people to get back in the market because they want to buy the dip. The market's off all-time highs by a ton. They start cost averaging in again, buying, and then finally the Federal Reserve takes the foot off the brake and we rally and maybe retest those all-time highs. I'm not saying this is going to happen. I hope it doesn't happen. But it makes sense, right? It does make sense that why are these big institutions keeping their money in the market when there's opportunities to make similar yield in bonds that have absolutely no risk, right? Something to think about. I still think there's a lot of good trades to be had out there. There's a lot of money to be made out there still, even in this climate. But you just got to hunt for them. You got to hunt for those good deals. Maybe it's on the short side, right? You think the market's going down? Maybe it's on the short side. I'm going to be going live every morning. Try to do it every morning, 9:15 a.m., 9 a.m. So if you're into that type of thing, hit the subscribe button, hit the like button, and I'll catch you guys in the next video. And let me know what you think in the comments. Is the market crash really coming? Is this guy right? Or is he just spreading FUD and we're about to see all-time highs? Love you, and I'll see you in the next video. Until next time, peace.